Welcome to the Performance Monitor for March 2017. My name is Barney Hawkins and I've joined True Potential as Investment Director. Today I'll review how markets have performed during February and then look at some of the key issues globally. Looking at returns, we've seen positive figures from virtually all asset classes. The US has led the way with continued positivity around Donald Trump and his planned reforms in America. After the last few months of negative performance from fixed income stocks, bond markets have rallied, offering returns of around 2.4% for UK investors. On the currency markets, sterling has weakened against the US dollar, which has been a benefit for UK-based investors holding dollar-denominated overseas assets. In America, Donald Trump continues to dominate financial headlines. For some, his forthright, America First, protectionist approach threatens the delicate balance of global trade. For others, particularly the financial markets, his promise to reduce taxes, impose border tariffs, repatriate offshore manufacturing, and invest in infrastructure projects represents a clear commitment to revitalizing the US economy. The consensus view among our manager partners is that these messages will put upward pressure on inflation, leading the dollar to strengthen and economic growth to improve. But interest rates at current levels look increasingly inappropriate for such expansionary policies, and the US Federal Reserve has hinted at a further tightening of monetary policy with 2 or 3 further hikes in interest rates forecast during the year. Whether Trump's initiatives will serve to extend the current economic cycle remains a moot point among our managers. But markets appear happy to back him in what, financially speaking anyway, has been one of the most optimistic starts to a new presidency. Over the last month, the Dow Jones Index has hit a new high of over 21,000, up 4.8% over the month, with the wider S&P 500 index up 3.7%. The UK has followed suit, with the FTSE 100 up 3.1%, touching a new high of 7302, and the broader FTSE 250 index of mid-cap companies up 3.4% in February. Turning now to the bond markets, one side effect of the economic optimism surrounding the initial days of the Trump presidency has been the greater likelihood of inflation. For policymakers in the US and also here in the UK, this presents a conundrum. Do they begin raising interest rates to more normal levels and risk derailing the recovery, or do they leave policy unchanged and risk having to take more dramatic action later should inflation begin to get out of hand? The general perception is that interest rates are likely to rise before long, but that the rise will be modest, and after a difficult January, bond markets rallied, with UK bonds up 2.4% over the month and global bonds up 1.9% for a UK-based investor. So, looking ahead, there are, as ever, conflicting signals, and some investors are conscious of the US and UK markets touching new highs. However, our objective when building portfolios is to listen carefully to what our manager partners are telling us and to balance the potential risks with the need to seek rewards. Increasingly, our managers are looking towards alternative investments to counter elevated valuations in the equity markets, as well as to find additional sources of sustainable income away from the bond market. The critical element in all of this is to remain diversified across all asset classes and to invest for the long term. The last 9 years of exasperatingly low interest rates should have provided a salutary lesson for investors who worry short term but have savings needs that stretch out over the much longer term.
Hello ladies and gentlemen, and welcome to the True Potential commentary on our True Potential portfolios. So before we start, what I'd like to do is inform you of a milestone. So we've now gone through the £2 billion barrier of money received into the True Potential portfolios. And for me personally, I've never seen so much money come into an investment product so quickly. So let's just take a step back and think about why is this? So the first reason is that clients can see the benefits of advanced diversification, taking diversification to a new level not seen elsewhere in the marketplace, and that is diversification around fund manager style, reducing down that single fund manager risk. Next, the portfolios now have more of a track record. We now have 17 months worth of performance for the portfolios, and the underlying funds that make up the models now all have at least 3 years. And more importantly, that track record is excellent. Okay, so let's move on, and I want to discuss now the performance of the portfolios. What kind of changes have we been making during February? And then look at what are the key themes that we're seeing from the fund manager partners we work with. Okay, so let's start off by looking at the month of February. And you can see performance has been strong with both equity and bond markets having performed well. Over the longer term, since we launched on the 1st of October 2015, figures are excellent with investors being rewarded for taking risk. So as you will know, we speak to our fund manager partners at least monthly, and what we're doing here is we're looking for any short-term key themes, and then what we can do is we can tilt our portfolios to take advantage of them. I think I speak to a lot of advisors all the time at the moment, and actually one of the things that they're saying to me right now is that they feel that markets are pricing on high valuations. The thing is, the True Potential portfolios, the way they're invested, it's multi-asset portfolios, so there will always be pockets of value. They aren't just invested into one geographical area. And two areas that our manager partners feel look interesting right now are Europe and Japan. Okay, so starting with Europe, our fund manager partners perceive this area to offer the attractive prospect of higher returns. Relative to the US, equity valuations are much lower, and European company earnings are benefiting from what is a relatively weak currency. Political uncertainty in Europe remains high, but managers view dislocation from political fallout as actually a buying opportunity. I think the other area that looks good value right now for many of our fund manager partners is Japan. So Japanese equities are appealing to some of the managers. That's because they're attracted by low price to book values and favourable corporate debt levels. Also, looking at a higher level, accommodative monetary policy and political stability. Okay, so let's move on and let's take a look at the trades, the movements in positions that have been taking place during February. So rebalances have been placed for the Balance Plus portfolio. So within Balance Plus, what we've done is we have added to the True Potential Schroeder Cautious Fund. And we've done that to help increase diversification and also to reduce model exposure towards bonds and also increase exposure towards cash. Within equities, Schroders select funds with a value bias, and they also identify funds with alternative strategies, and this is what really helps with that diversification. The True Potential SCI Cautious Fund was reduced, and that was due to SCI's exposure to global minimum volatility equities. And this is an area that has seen huge inflows during 2016, but again, it's increasingly associated with bond proxies, which correlate with bond price movements. Okay, so let's look at the rest of the True Potential portfolio range. And allocations have been kept the same. The key thing here is the optimization of our 4 factors that continues to be paramount within the portfolios. So just as a conclusion, the investment landscape continually evolves and investors must judge where best to place their hard-earned money. At True Potential, we use advanced diversification, confident that our manager partners will provide a good outcome as markets evolve. Our framework of looking to optimize risk, cost, long-term expected return, and risk-adjusted return allows True Potential to align the portfolios to client interests. Thank you very much.
Close's stock picking has been positive, as has their short duration positioning and being overweight equities and underweight fixed income. Close have a 50% hedge back into sterling as protection, which would benefit should we see sterling start to strengthen. The US dollar is around 64% of the global reserve currency base. However, the euro is 20%, so movements here could also have a large effect. Inflation is a worry if we see more protectionism. Close feel that interest rates are rising, but they see more modest wage inflation. They do not see a sharp rise in inflation. They feel that property adds to diversification and is an area Close have not liked for a long time. However, be aware it is equity, not direct property. They see property as an inflation hedge. Originally, the funds were positioned skewed towards equities, but now Close are looking towards more of a balance of equities, bonds and alternatives. The income fund was up 2.1% in February. Over the month, duration has been reduced from 4.8 years down to 4.3, and the fund is yielding at around 4.26%. SEI continue to offer solid performance. They have introduced a new US small cap portfolio manager and are also still looking for a new global frontier market manager. They see earnings in the US potentially pushing higher and feel that cyclicals should benefit. This is an area SEI are overweight. They see healthy inflation in the US and do not believe inflation will become out of control. They feel the US economy is robust, expecting it to stay that way, and that sterling may strengthen slightly over 2017. Schroders' view on the US dollar is at odds with their recent purchase of gold and their holding of gold miners. They see gold as a hedge against a short-term spike up in inflation. They also believe that the US market and the US dollar is an overpriced reserve, which may tumble. Gold represents a hedge in that event. Now, with regards to Trump, he is expected to speed everything up. Economic growth will lead to inflation. Inflation will lead to a rise in interest rates, and higher interest rates may bring forward the next downturn. If Trump was happening at the beginning of the cycle, then it would be very bullish, as he is happening at the end of the cycle. Whether he will hasten the end of the cycle or prolong it is the big question. The True Potential Threadneedle Monthly Income Fund was the top performer within the growth risk category, returning 4.3% over the month. As a UK fund, Threadneedle are conscious of how Brexit plays out, but feel that holding a quality portfolio of stocks is the best way to navigate through potentially negative events. Domestic companies have been weakened post-Brexit, and this is likely to throw up opportunities. Looking at Europe, they are wary of political uncertainty, particularly in France. With regards to sterling, other than a short-term wobble around the triggering of Article 50, they think that the pound is close to its lows and due a rebound, so are looking to reduce overseas earners. The fund is currently yielding around 3.5%. 7IM are relatively constructive of economic growth, see dislocation in currency markets, seeing opportunities in US small cap, but valuation in the US relatively high. 7IM don't expect Trump's fiscal spending to start until 2018, with inflation not coming through until a year later. The key diversifiers within their funds are alternatives such as their inflation-linked note and their dispersion trade. Within equities, Europe is undervalued, currency is low. Japan is also a big bet for 7IM. US small cap, India and banks for the higher risk funds are the areas which 7IM see opportunities to generate returns. UBS has been the big performer this month, with the greatest return seen in the aggressive category, as a True Potential 7IM aggressive fund returned 3.85%. Looking at positions, UBS are overweight value, and that is specifically Europe, Japan and emerging markets. UBS have mixed views on sterling, with short-term fair value being around 1.35. However, over the very short term, you could see the US dollar move even stronger. UBS do not have a UK bias, as many UK-based funds do, and will not add to the UK purely to have a bias. UBS favour the US over the UK, with the US looking fully valued but not overvalued. They feel that the minimum volatility and RAFI products complement each other and provide a good balance of risk. Turning to Allianz, Allianz can react very quickly to how events may change markets and can add or reduce risk depending on the levels of volatility within markets. Allianz favour Europe based on relatively cheap valuation and supportive valuations. In terms of duration, they are neutral to overweight. On the UK, the risk that inflation will tick depends on how much price will pass through. Wedges facing a downward pressure from services, real PPP falling and therefore sanguine on UK gilts. For the True Potential Goldman Sachs Income Builder Fund, there have only been modest changes over the month. Looking at what areas are the most attractive, Goldman's prefer, in order, equities, credit, then rates. Over the last 6 months, Goldman's have been gradually reducing their underweight to equities. The US and Japan are their preferred areas within equities, but they feel that Japan is too low yielding. The yield of the fund is 4.3%. Within fixed interest, they are favouring the higher quality end of high yield, looking towards high BB or B. For Goldman Sachs Dynamic, volatility has been low, and Goldman's have seen a good performance from equities since the US election. Looking at bond duration, Goldman's forecast 3 hikes in US rates this year rather than the market's 2. In the UK, we have seen positive economic data, but not a lot to keep yields low.